Don't you just want to save yourself the trouble when picking stocks and do the research yourself? Ideally, when it comes to analyzing stocks, it's great to consult an expert on the research, as it'll mean there's less work for you to do and you'll probably get better results. However, hiring someone to analyze stocks will cost you some money, as you have to actually pay them. And if you're one of those people who are meticulous about spending, then it's probably better for you to do the work yourself and save the money. Fortunately, researching stocks can be learned and practiced even on your own. Luckily, you can wave goodbye to all that spending because you're about to do more investing instead. When it comes to investing, picking the right stocks is crucial to your success in the market. However, it can be quite tedious to do yourself, as it requires a lot of reading and, of course, research. It's going to take a lot of time as well, as you have to be cautious in selecting and deciding. These are just one of the many reasons why some people would prefer to hire experts instead. But for some of you who would rather save your money for the investment, then doing your own research might be the greater option. Hence, here we are going to provide you with a few tips and information on how to analyze stocks. So make sure to stick around until the end of the video to find out how you can effectively do stock analysis on your own. Hey, welcome to Stock Market Mate. Today we'll talk about analyzing stocks using fundamental analysis. Before we get into it, subscribe to the channel and hit the notification bell to help us beat the YouTube algorithm. If you're done with that, then let's get right into it. The two types of research for analyzing stocks. There are two types of research you can use to determine whether a stock is worth investing in: fundamental analysis and technical analysis. In essence, fundamental analysis reveals what to buy, while technical analysis indicates when to buy a stock. In this video, we will talk more about fundamental analysis as a way to select your stocks. Fundamental analysis and how it works. In a fundamental analysis, the intrinsic value of an asset is evaluated as well as the future price dependent upon the factors that can influence it. Various events and influences are considered in this analysis, along with financial statements and industry trends. Basically, a fundamental analysis involves obtaining insights and information from the organization to determine its intrinsic value. Furthermore, a fundamental analysis method presumes that the stock price does not necessarily reflect the true situation of the company. The most common metrics used for this type of analysis are revenues, future growth estimates, and return on equity, which will be discussed in the later part of the video. These figures can be found in the company's financial statements along with earnings and profit margins. The fundamental analysis type of research is good for when you're looking to make a long-term investment. Additionally, under the fundamental analysis, you have two categories, which are qualitative fundamentals and quantitative fundamentals. Qualitative versus quantitative. As mentioned, there are two categories under the fundamental analysis: the qualitative and the quantitative. Here we are going to be breaking them down to you in simple terms. So, qualitative analysis basically deals with factors that can't be measured, such as technology disruption, economic moat, or competitive advantages, etc. Technology disruption refers to the introduction of new products or services that have the potential to significantly alter consumer behavior, industries, or businesses. For example, if a smartphone company suddenly faces a new commodity that can replace all smartphones with tiny and more trendy smartwatches, which many people will prefer because of convenience and for its novelty, the smartphone business will probably suffer, as less and less people will be drawn to the company's product. Such is impossible to be quantified or measured. Therefore, qualitative fundamental analysis will be used. Furthermore, an economic moat is a term coined by investor Warren Buffett to describe the competitive advantage of a company. It is the capability of a company to increase profit margins and market share over its rivals. Brand identity or patents are common examples that are difficult to duplicate. These factors create an effective barrier against competition posed by other firms. These are also hard to quantify. Moreover, quantitative analysis, in contrast, can be quantified or measured through numbers. Examples of such are assets, revenues, earnings, cash flow, and many more. A quantitative analysis includes ratios such as price to earnings, price to book value, and price to cash flow. The downside to both qualitative and quantitative analysis is that they're both difficult. It will be difficult to know which information is relevant to the market out of all the information available. Ultimately, it's going to take a lot of knowledge and insight on the market as well as the events happening outside the market. Metrics to look at. Moving on, we will now discuss the metrics that will be used when doing fundamental analysis. In understanding how to estimate the future price stocks, you can utilize some metrics to help you. These metrics will help you determine advantages and disadvantages of a particular company. Such metrics include price-to-earnings ratio, also known as PE ratio. It is the indicator most investors use to calculate the stock's future market value. A measure of this kind indicates how much investors are prepared to pay for every dollar of earnings a company produces. A company's ratio is also used to compare its performance with others in the same niche or industry. As per stock market data, it is often best to invest in a company with a better PE ratio than one with a low one. Earnings per share. Although less reliable than others, earnings per share is another metric you could use. A company's earnings per share provides information about its profitability. The earnings ratio would be calculated by dividing the number of shares in the market by the number of shares available for purchase. Although this is a solid indicator, it doesn't reveal or show the company's capital allocation plans. For example, some companies reinvest the money in the company, others give it to the shareholders. It pays to educate yourself on these matters so you get the most from this metric when researching stocks. Book value. This metric represents the net value of all the assets owned by a company. In essence, this indicates the amount of money the company would have if it sold all its assets. If you are researching company stocks, you will often see the price-to-book or PB ratio applied. This compares the stock price and book value of a company. To calculate book value, use these three formulas. Book value equals total cost minus accumulated depreciation. Return on equity. Return on equity, or ROE, is an additional metric to look to. It can provide information regarding how much profit the company makes every dollar invested by stockholders. Generally, it can tell you a lot about the efficiency of a company, especially when it comes to generating profits. However, these indicators can sometimes be misleading as some companies can tweak or make changes on these metrics artificially. Queries to keep in mind when researching a stock. Being new to analyzing stocks, it's important to keep in mind some questions you can ask yourself when looking through companies one by one in order to effectively select one. Number 1. Do you have a complete understanding of the company's overall background? It's vital to know a company like the back of your hand when it comes to selecting stocks. You don't want to end up with a company with ways you're not very familiar with. Hence, you must remember to learn everything you can about the company. Look through their products, their business plans, as well as their history. Do not leave a single detail out. Number 2. What are the ways in which the company generates profits? This is of course very important to take note of as well. If you're investing in a certain company, you need to understand how the company creates its revenues. Number 3. What are their competitive advantages? What makes this company better than its rivals? As mentioned before, a company's competitive advantage is their economic moat, meaning it's what they have that others don't. In turn, it's important to get a good idea of what they are. Knowing this can weigh your options and therefore be able to make a wise decision regarding which is the best company to invest in. Number 4. What are the cons? Are there any disadvantages? Along with the pros, cons are very important in weighing our options, which is why you need to identify these disadvantages in order to effectively make a decision. Overall, researching stocks can get pretty complicated, especially if you're not used to it. But with practice, you'll find yourself able to do it easier. Just remember to be cautious and know every last detail that you can about a company. This way, it'll be much easier to decide on which stock you should and should not invest in. Well, that's about it for today. If you found this video helpful, kindly click the like and subscribe button. Also, you might want to leave a comment below. We love hearing from you. Thank you for watching, and we'll see you in the next video. If you enjoyed this video, you're going to want to watch one of these two videos right here. Enjoy!